Done.
Can everybody see my market monitor?
Yes.
Okay, I'm gonna wait a couple minutes, but
I still have the impression that a lot of people don't know this is happening
yeah,
based on the attendance.
I mean, it's pretty much you, Manny, a couple others. We'll have to figure out a way to.
I think we need to get the word out more, because I just can't imagine, you know.
I've never,
What would your suggestions be?
I don't know. I'm just saying that our
Yeah.
attendance, Anton usually has
Well,
a high attendance.
I've never been so unpopular.
Yeah. And Samantha, yeah, you wouldn't know, but this is usually like super well attended, and there's just been such a, you know, just in strange times. I don't know. I guess I would send some emails. I mean, I don't know what else you can do.
Yeah, we can work on that.
Yeah. I mean, I can't speak to the texting format. But it seems to me anyone seriously conducting business does have to be in their email. Would you agree, Anton?
Yeah, we'll figure out and see if it improves for the next go around. So we'll figure out a couple different strategies. So
Yeah.
all right. Well, I see Chris is on here, and Sean, and I'm not sure. Let's see who else. See Samantha. All right. So feel free to ask questions along the way. We do have a smaller group, so I don't mind stopping and going through this. So for those of you who might not have seen this before, Sean has seen this many times, but this is the market monitor that we all have access to on MLS. So what I like to do is the first Friday of every month, now that the previous month is over and most of the data will be in MLS, I go through all the important data points on here. So on your market monitor, all I'm doing right now is all price ranges, just residential, not doing land, all property types, all construction, which includes new construction. So what I wanted to share with everybody is like, okay, where's our trend? You know, where are we headed and where have we been? So if you look at the first tab on here is the median sales price. So, and I tend to stay to median and not really look at the average. So on median sales price, so it's very interesting if we look at the last 6 months. So, and I'm doing this on a monthly basis. If you look at the last 6 months, we really haven't changed very much. You know, August was 315, 310, 316, 319, 314, 315. So it's very interesting. The last 6 months have been relatively flat. Now, if you look at year over year, we're up 9.5%. So what that means, if I go to January 2021 and I go back to January of 2020, so we were at 287.5. So January of last year, because remember, I'm not looking at February because we're only 5 days into February, so we don't have all the data. But if we look at January a year ago, the median sales price was 287,500 in all of Charleston. And now we're sitting about 315. So that's a 9.5% higher median sales price. And again, 2020 being your very non-traditional seasonal year. So you can see how we started out 2020 very flat in the spring months. So here's April, May, March. Well, why was that? Well, that's because everything was shut down, right? I mean, we pretty much came to a standstill in March or in April. So that reflected all the way through to June, right? Because March, April, May, if you're not writing contracts, you're not closing them in June. So you can see a very flat spring, which is very non-traditional seasonal. And then we had that jump up between July, August to get up to 315. And we've been flat for the last 6 months. Well, traditionally in the winter, it's not surprising to see a relatively flat and sometimes even declining median sales price. So if you look at the end of 2019, which was, if you want to look at it, that was our last maybe traditional seasonal year, because 2020 throw that out the window. September, October, November. So you can see this decline going into the winter is not, that's not unusual on median sales price. Whereas this past winter, we're flat, which is showing me that prices are going higher. So a flat price is showing me we're going to have a bump coming forward, once we get into the traditional selling season, which we are, for the most part, already there. You can also go back further, so if we go back, let's go way back. So this is monthly, and it goes all the way back to 2004. And if we look at a rolling 12 months, you can see a pretty steady growth from 2012, right? It's fairly steady line going up, but with a pretty, like you can just tell, this is a steeper curve heading higher right in here at the end, right? So this is the, coming out of shutdown COVID part of it, the effects coming out. But if we go back, let's just do 3 years again. So you can see it's flat over the last 6 months, but flat in the winter is not necessarily a bad thing for prices. Look at price per square foot. So price per square foot, again, fairly flat over the past 6 months, but still increasing. So we're 10.1% higher on price per square foot. And then we have, if you look at percent of original price, so we're at 99.5%. So, on average, the median, well, I should say the median, so I'm on the median right now. So half the homes, what that means is half the homes in our MLS are closing under 99.5% compared to list price, and half are closing over. And I would venture to say that a lot of them are closing over 100% at this point. And I just closed one last week that was 103% of list. So that is certainly bumping up the median. And so just keep in mind, there are some of these closing over 100%. So a year ago, we were at 98%. And you can see, fairly flat. If we go back a little further, let's go back 5 years. So 5 years, 16, 17, 18, 19 all look very similar. And you can see the rise in the spring, right? So here's the peak, May, June, July, May, June, July, May, June. So you can see the rise as we go into spring. This just kept rising even through the winter, right? So I wouldn't be shocked if we're hitting 100% this spring, where the median, half your sales are over 100% or half are under. Now, if you want to look back historically, let's go way back. So you can see at the worst part of the recession, we were at 91.5%. So think about it. Half the sellers were negotiating over 8.5% off their list. That's unimaginable today. But for those of us who were in the business back then, that's what was happening. Now, I think there's a data issue back here. If you look at 2004 and 5, I don't know why it's capping at 100%. I'm pretty confident we were over 100% back in here, but I don't know why the data stops at 100. It'll be interesting to see if it's a glitch in the program, and if we cap out 100 here, that's telling me we were definitely over 100 back here. It's just not reflecting it. But we had our growth back in 11, 12, 13, fairly steady for a long time, and then now we're growing again and heading towards 100%. Let's go back to 3 years. So here's days on market, right? So days on market, again, this is only the past 3 years. So you can see in the winter months, right, it goes higher in the winter months. So here's December, January, February. There's December, January, February. And then what's happened is we've dropped. So we're a year ago would have been right here. So January of last year, we were at 27 days in the market. January of this year, we're at 11. So again, this is median. So that's saying half the homes are going under contract in less than 11 days, half are going under contract in more than 11 days. Now, something on here that I wish they had is days on market from the final list price, meaning this is even lower than 11. Because think about it, a home can be on the market 200 days, they change the price and they sell in 5 days. Well, all that matters in my mind is the 5. So if you have a listing and you're on the market more than 11 days, you're worse than average at that point. It's like, okay, the market is telling you you're probably overpriced. So again, that 11 days is that trigger point saying, okay, if you haven't sold within 2 weeks, that's a sign that the market is telling you you're overpriced. But you can see that rise in the winter these last few years. Here's 18, 19, 20. That's very normal. And we never had it this year. Our rise was from 8 to 11. So I expect this, as we're going forward, this might even go down back under 9, 8. It could be less than a week as our median days on the market. So your buyers are having to react very quickly. But also, if you have a seller and they're on the market for 30 days, the market is definitely a sign that you're priced too high and you need to make some adjustments, whether it's the condition, price, combination of all of the above. Here's months of supply. So again, I think I say this every time. If I only knew one piece of information to know how the market's doing, it's months of supply. So months of supply, you also have, you'll hear it also called months of inventory. So the way that this works is that, again, we're doing this monthly. So the entire MLS, all of Charleston, Tri-County area, all our MLS, 1 month of inventory in December, in January, 1 month. And again, I know not everybody's been in the business as long as I have, but that's incredible how low that is. If we go back in time, I'm going to go back to the max. So back in 2004, we had 4.7 months of inventory. The lowest number we got pre-recession was 3 months of inventory. And then you can see we went to 17 months of inventory at the worst part of the recession. And then we had, a good part of a decade working that off and getting back down to 3 to 4 months. This is a very healthy market. Like 4 months of inventory, in my mind, is a healthy market. I know everybody says 6 months is the dividing line between a buyer's market and a seller's market. I feel like 6 months of supply would be, maybe almost a dividing market between prices going up, stable, or down. I think 4 months is kind of a normal market as a whole. And so pre-recession, the lowest we hit was 3. We are at 1 month of inventory. So for those of you who weren't in the business back then, we are 3 times faster in absorption than we were pre-recession. I honestly didn't think that would ever be possible. Now, I also want to point out, this is not just, what's happening with COVID, but if you look at, and I'll go back, I'm only going to go back 3 years to show you this. So you can see this is, again, March was the shutdown of COVID. Look at what was happening here. We were already on this downward trend. So here's the dividing point, as I call it, between before we knew about COVID and after, right? So we were already on this downward trend, and then we went sideways during the shutdown, and then it just came out of the shutdown in vengeance, and it's going down. And again, it's not like there's a V shape to this. It's not all of a sudden next month going to start jumping up. We are still in this downward trend on months of supply. And again, depending on your seller, one way to explain months of supply, if you have 1 month of inventory, every home on the market, if it's priced right, should sell in that month. You're basically turning over your entire inventory every month. Back when we had 17 months of inventory, 1 out of 17 sellers would sell that month. Now it's, if you're priced right, every single seller, if they're priced right, should be selling this month, which again is unheard of. We're 70% faster than a year ago. So here's homes for sale. So obviously months of supply consists of how many homes are for sale and how many are selling. So here's our inventory, right? And we were already, again, I'm kind of making a point, we were already heading this direction pre, the shutdown. We were already starting a lower trend on inventory. Coming out of that just has even amplified it more. So I looked a few minutes ago, we're at 1999. I saw we got down to about 1,950 homes for sale was roughly the lowest number that I saw. Now I want to put that in perspective when we go to the closed sales. So keep in mind 1950 was the low. We're about 2,000 right now, but we're 63% lower than a year ago. And I went back and looked at, because I watch this number like a hawk. So every day I'm watching if the trend is higher or lower. So around Thanksgiving, we had about 3,000 homes for sale. So how long ago was Thanksgiving? Not that long ago, right? So we went from 3,000 to 2,000 from Thanksgiving to today. So if I'm a buyer at Thanksgiving, I can show you 50% more homes than I can show you today. So if today I can show you 2, at Thanksgiving I could show you 3. So that's what's causing this instant demand. When a house hits the market, there's this feeding frenzy towards these houses, is because you have this pent-up demand that these buyers have already exhausted the inventory they're looking at, right? Everything that's on the market, they've already looked at. So they're waiting in front of their computer, by their phone, and the agents are doing the same thing. They're waiting for a house to hit the market, and they are literally jumping on it. We had a couple agents in our office that a house hit the market in Mount Pleasant this week. Within an hour, they're sending me pictures from the house, and there's cars lined all the way up and down the street. And there were 14 offers from my understanding on it. And it is this instant demand that is driving this market. And that's what's happening to these prices, is people are paying based off supply and demand and less off the historic comps. You know, if it's the best active on the market at that price point, somebody's going to buy it. So it's a market being driven by supply and demand, and sometimes the comps don't even matter. So you can see, and if I go back historically, let's go back in time. So I just wanted to put this in perspective to everybody to look at this drop off. But you can see we had already started that downward trend pre-COVID. So if you look at this drop off, 2,000 houses for sale. The lowest we ever got pre-recession was 4,000, right? So we're half of the lowest point we were pre-recession. And I just want to put that in perspective for everybody. How many more people live in Charleston 16 years later than here? So your ratio of people living here needing houses compared to 2005, it's less. I mean, again, we have less the houses for sale, but we have a lot more people living here. Now, I also want to put in perspective, look at the peak. We were at 12,000 homes for sale in 2007, 8, almost in 2009. In this window here, we had 12,000 homes for sale. So we have 1/6 of the peak that we had here. And we took years to work this inventory off. And then we stabilized in this period of time. But that drop off is massive that we've had here. And then if we go, so I'll go back to 3 years. So if I go back.
Anton?
Yes.
Anton, would you say, since like that period, if you could go back to the stabilized period for the inventory?
Yes.
The last, yeah,
Let me go back.
that you were just on.
Yep,
Would
right in here.
That stabilized period, to me, that would mean that we've got a pretty good balance of demand and supply, correct?
Yeah, I mean, I think this is a healthy market in here when we were about 6,000 homes for sale.
And
Right,
we
so-
might need, since that many more people have moved here though in the past year or so, we might need a little bit more when we come back out of this.
Yeah, we might need a little bit more, but we are, again, I think we're years away from getting a balance.
I agree, yeah, for sure.
We are still on a downward trend, which is hard to believe.
Yes.
So when are we going to get to 5 or 6? I mean, think about it, 6,000 houses is triple the inventory we have right now. Is that going to happen this year? Well, unless there's some other dynamic that we don't see coming in the world, I don't see how we get there. So, I mean, I think we have a couple years of dealing with this, undersupply, over demand situation. Obviously, if interest rates start to adjust, that'll slow down the demand. But in my mind, that's also going to slow down the supply. I mean, ask agents, and it's like, I got sellers, but they're not sellers until they find a house that they want to buy, and we're not finding a house they want to buy. So they're not sellers. To have a transaction, we got to have a seller. And right now we're missing those because the local sellers aren't finding places to go. Yeah, the one that's moving to Boston for a job, sure, they're still going to list their house and sell it. The one who wants to buy a house up the street, there's so much competition that they're hesitant to list their house because they're going to be homeless. They don't know where to go. So we kind of have this log jam happening. And think about the influence of out of the area. I know Charleston is no longer, a very inexpensive place to live, but compared to some other parts of the country, mainly kind of Virginia, DC, all the way up to Boston, that whole Northeast corridor, California, some in other places around the country, we are cheap. So when somebody comes and looks at a house in Charleston and it's 600,000, they don't even argue. They're like, sure, I'll take it. We got low property taxes, we got low state income taxes relative to where they're moving from. Now, it might be a different story if you got somebody coming from Texas, let's say. They have no state income tax. The house prices are more reasonable in some places there. So Charleston might seem expensive to somebody, moving from Texas. So, but there's enough of the population that thinks Charleston is cheap. That's what's helping to drive these prices higher and drive the demand. So, we are very challenged on homes for sale. And it just keeps this is not a V that's about to happen. And think about it. I mean, it took us, we were middle of 2019, we were about 6,000. So we're a year and a half into this with no sign of coming out of it. Best case, we have another couple years to get back to even close to that. So again, this is a very important number to watch. And again, I watch this daily. Like, what's this inventory doing? Is it up, down? Which way are we going? And I think once we start an upward trend, then it will slowly happen that direction. But you can also see this seasonality every year. There's a little bump in the spring, summer, a little drop off in the winter. So you can see that seasonality every year, except for 2020, because that's like no other year we've ever seen. We just kept going down basically the entire year. Closed sales on here. So when we look at the closed sales, you can see the seasonality in the closed sales, right? Historically, you see the peak, and basically every month that's the peak of the year is pretty much June. June is traditionally your highest closing month. Now, forget 2020, July was, because June was some of those April, May contracts where we're still in shutdown, still trying to figure things out. So July ended up being the peak month last year. So this was not a traditional seasonal trend. We saw the seasonality come to us in January, right? January and February are traditionally the lowest months. So if I go, here's 2013, it was January. 2014, it was January. 2015, January. So you see my point is the low is where we're at right now on closings. That doesn't mean contracts, right? So we are jumping up on the contract. So if you follow this trend where we have 1,418, that's still 21% higher than a year ago. Now it's going to be very interesting because the media, we were in shutdown mode in March and April for the most part, right? So those were very low months. So on a national level, the number of pending sales is going to crush last March and April. So the media and everybody, oh, look, we're up 40%, 50%, whatever the number is, you're up. Well, that's because we were completely shut down. We might start to run into having a hard time matching that on the back end of the year. So, and again, you got to have a seller to have a transaction. If we only have 2,000 homes for sale, it's going to be really tough to keep up a pace of selling 2,000 homes a month. So again, it's going to be very interesting to see what happens the second half of the year. The first half of the year, sure, the number is going to blow away last year. But the second half of the year, it's going to be interesting. I'm not saying it's going to be bad, but it's going to be hard to be a higher comparable in some of those statistics. New listings. So you can see the seasonal trend here, right? Like in every year, we have that same seasonal trend. And the peak new listing month, if you look at almost every year, is what? It's March for the most part. Forget 2020. Here's March. Here's March. Right? So what month is this? This is February, right? So if we get back into a seasonal trend, which 2021 is still not going to look quite the same, but we are almost at the peak listing month of the year, which would be March on a traditional seasonal trend. Maybe it's delayed a little bit. School is a little funky this year. The kids are getting out 3 weeks later if you're in Charleston County. So I think it's June 18th. I don't know about Berkeley and Dorchester County, but everything's pushed a little bit. So maybe the seasonal trend pushes into April, maybe even May. But think about that summer move time for people with kids, right? So if June 18th is the end of school, and I don't have a calendar in front of me, let's say August 18th is the beginning of school. It's probably not far off from that. That's a 2-month summer, right? So is everybody going to try to cram moving their kids over those 2 months? Maybe so. Maybe there's a little more flexibility this year, but our summer is really shortened this year. So it's going to cause some different seasonal effects on here. But you can see on the new listings, we did jump a little bit in January. So we're higher. But if you look at, so we were at 1867, look at last January. Let me find it. So we were at 2105 last January. So we're actually lower on listings. So think about that for a second. Higher contracts, higher closings, lower listings. So what is that telling me the trend is? The trend is it's still hard to find listings. Now, there are so many homes being sold off the market right now. That's kind of, this isn't fully accurate if you knew how many are really for sale if you go outside of MLS. So this number is probably not lower. In my mind, it might even be higher. It's just this is what's recorded in MLS. So be careful with this number because there's a lot of transactions happening, not even hitting the market. Here's your pending sales. So we jumped 35% year over year in pending sales. So look at December to January. We have a net of almost 600 higher pending sales in 1 month. So you can see we started out the new year right off the rip jumping, and compared to January a year ago, we had, find it, 1,581. So we have, a good, 570, 560 higher year over year. So, I mean, that's a fairly significant jump in pending sales. You still see the seasonal trend, right? And again, I want to point out to everybody, when's the peak? Traditionally, March, this was a little bit later, May, and last year was all funky. It was July, right? So July was the peak last year. So we are starting out, look at that. We're going to get pretty close to, I bet in February, we might be close to July. But honestly, this is what's in MLS. Think about how many houses are under contract, not in MLS. I wouldn't be surprised we are actually higher in January than we were last July. If I add to that number, I bet we're up in here somewhere. So we are starting off the year very strong with under contracts. And then if you look at dollar volume, so look at dollar volume, the jump coming out of, you remember we closed $1 billion in July, which was the first time we've ever done that. But we had July, August, September, October, November, December, all over 900 million, or 850 million, I think was the low. So if you look at that, those are all records, all in the same year compared to historically where we've been. Now, January, sure, it fell off to 648 million. That's still almost a record. So January is seasonally always the slowest, January, look at January's here. There's January, here's February. This is the time of year where there's January. That's always the slowest close because when are those sales, those closed sales from January, those are Thanksgiving to Christmas to New Year contracts, right? So that's traditionally your slowest closed month. So you can see that drop off right here. Now, historically, if we look at the average, look at that jump. If I get rid of the monthly, look at that massive jump coming out of COVID. Now, it's going to be interesting if I zoom in a little bit, and let's only go back 3 years, you can see how steep it was from June, July, August, September, October, November, December, but you can see a little bit of, what I feel like it's a little bit of a curve here flattening out. So it looks like, and I'm not saying this is topping out, but it's still an upward trend, but it is, at some point, we don't have enough houses for sale to keep up that transaction count. And so you as an agent, you're having to dig to find properties for your buyers or to find a listing. So this has become the 2021 challenge as agents is like, we all have, if you ask most agents, any agent you're talking to, ask them, do you have more buyers or sellers? I can't think of one that has told me, when I ask that question, I can't think of one that has said, I have more sellers right now than buyers. So we are at such an imbalance of buyer demand compared to seller desire to list. And a lot of your sellers, and I think I see, Jan and Karen on the call here, very experienced agents, it's like the roadblock that I think we're feeling is that the seller's like, yeah, rates are low. I'd love to buy a different house. But if I list my house, where the heck am I going to go? There's nowhere for me to go that I'm excited about. And if it is, it's gone in a matter of hours, and they're not even getting a chance to do that because that out of town influence of, or even the local tenants that are ready to go that don't have a house to sell, you know, you're taking a chance as a seller. If you can't find a house to buy, you're listing and selling your house, and you're basically making yourself homeless and hoping the right house comes on the market. But the stories that I'm hearing, when you have 15 offers within a day, the seller's not willing to take that chance of, basically agreeing to sell their house without having a definitive answer of where they're going. So I think that's the challenge we're going to face the rest of the year for sure, is that with that such an imbalance, it's convincing sellers that they can sell their house and be able to find another one in time, to be able to move. And from a price standpoint, again, when we go to the sales price here, if I go back, and again, I'm taking the 12 months, we're still on an upward trend here. So, I mean, you can see if you get rid of the seasonality, we are still on an upward trend. So year over year, if we take 12 months of data, we're up 8.4%. So now I can show you some houses that seem to be jumping faster than that. But I think in some areas, we've been going up 1% a month. I mean, I can show you some houses. I could show, definitely have some data to show you we've gone up 12% in 12 months. But on the entire MLS as a whole, it's 8.4%. And, Jan and Karen or any of the experienced agents on this call, I talk to agents around the country, and I don't really talk to many agents that don't feel like a similar market to where we're at. Whether it's up in DC or in Austin or in Charlotte, it feels like they're experiencing what we're experiencing. And it's amazing that that can happen across the country all at the same time, because you think, oh, well, people are moving from area A to area B. It's like, well, how are both areas of the country so healthy from a real estate? I'm not going to say healthy, that might not be the right word for buyers, but how are they all so active at the same time? And, I think part of the dynamics is that COVID has taught a lot of people how important the house that you live in is in your life. And especially if you have people working from home now and spending, they're homeschooling or they're spending a lot more time at home, all of a sudden that importance of the house and location and layout and finishes of where you live has ratcheted up tenfold. And we're experiencing, in my mind, this step change of value because COVID has created a situation where people are putting way more value into where they live. And that can be from a location standpoint. I mean, how many people are you working with that can work from home and they decide, why am I working from home in Philadelphia when I can live in Charleston? So all those dynamics are pushing, the inventory lower, the buyer demand higher. And again, are we going to have a much different dynamic in the US over the next year? I mean, yes, it will change over time, but we're not going to March 1st and everybody's going and living the way that they did a year ago. That's not happening. So we've got this dynamic continuing forward with this trend of high buyer demand. And as long as rates don't change, which again, we'll see what happens in a year, but I think they're going to try to keep rates as low as possible for as long as possible. So we probably have most of this year with very low rates. As we move forward, let's just fast forward 2 or 3 years, and I'm not saying that this is going to happen, but let's say rates are at 4.5% in 2 or 3 years. Well, what's going to happen to the market when that happens is that it becomes less affordable on a monthly payment basis for buyers, right? If you're going from 2.75 to 4.5, it's less affordable for the buyers. The buyers moving from out of town, they might buy a less expensive house if they're payment based. So that'll push them from maybe, let's say they're buying an $800,000 house today, maybe they're at $600,000 in 2 years. But if you're moving from Chicago or Boston or somewhere else, you just pick a different neighborhood, you pick a different house, but you're still probably moving here. Who it's going to affect are those local sellers / buyers. So if you're a local homeowner and you have either purchased or refinanced in the past 10 years, you probably have a rate that's, if not below 3, it's probably in the low 3s. So if rates are 4.5, you now have a disincentive to move from your house up the street to a different house, right? So and again, I'm sure there's some people on this call that are in this situation like, hey, I'm in this house, but rates are 2.75. What can I get if I move houses? Because right now I'm at a different rate. Well, that thought process is gone if rates are 4.5%, right? You're not going to move unless you have to a higher rate. You're not going to leave your house because of the rate just as much as the other factors. Maybe you'll renovate the kitchen or add a screen porch, or you'll start to spend your money on making it a better place to live, but you're not going to sacrifice and move away from your rate. So that's why, from a standpoint of the market, I'm not necessarily, I know you might read some articles about this real estate bubble. It's like, okay, wait a second. The supply is going to stay very low if rates go up, right? The demand should stay high as long as the rates are low. The supply will remain low if rates go up because people are just going to stay put, which is, again, not great for us as real estate agents because we need transactions, but the sellers are going to stay put because they have such a low rate. Now, I also want to, because I know a lot of us, I know Karen and Jan, we were around for this, and I want to point something out to some of the newer agents, is that this back here was all fake. Right? Lenders were loaning money to whoever could fog a mirror. There was no validation of what they were making. Who cares about the credit? Who cares about a down payment? Who cares whether they're buying it to flip it or living as a primary? None of that mattered, and that caused this problem. So I want to point out the difference right now. Most of the buyers that I see these days are primary residence buyers that generally have solid credit, income that's verified, savings if something went wrong. They are very solid buyers. Here, you would have somebody who will be buying 5 houses, and honestly, they shouldn't have been buying 1. So that caused this problem. I don't see where that problem is right now. The lender is still verifying everything. It's still tough to get a mortgage, which I am perfectly fine with. Leave it that way. So it's a different dynamic where you have primary residence people that are verified income, and everything is verified. They have to have decent credit. Everything is lined up with where the lender should be loaning the money. But also another thing I wanted to point out is back here, when this happened, the problem really started to compound when all of a sudden a lot of the homeowners that had borrowed 100%, they were literally upside down on their house. So they were 20% upside down on their house when this happened. So if they couldn't make a mortgage payment, they didn't care because they had no equity in their home. So they could stay in their house for 1.5 years, 2 years. The lender would try to evict them. It was a long process. So they didn't care about their house. They weren't maintaining their house. They weren't making payments on their house. And so that's what happened here. Now, if we fast forward to today, who doesn't, with the rise in prices over the past 10 years, there are very few people in Charleston who I would say don't have a decent amount of equity in their house if they're a homeowner. So if a problem happens in a household and maybe somebody loses a job or has some financial problems, they're not going to walk away from their house, right? If they have a lot of equity into it, they're going to borrow from their sister. They're going to get a roommate. They're going to do whatever possible to keep making that mortgage payment because they have equity in their homes. And let's say they've tried everything possible and they just can't make the mortgage payment, which I know there are some people in that situation. When you read the forbearance, statistics, there will be some people that are having that problem once, that is lifted. Yes, that is there. However, how do they solve that problem? They stick a sign in the yard. Right? That's different. Back here, when you had negative equity, you didn't care. You were going to stay in your house as long as possible. Now, if you have 20, 40, 50, 100,000 equity in your house, and you can't make that mortgage payment, you're going to put a sign in the yard, get it sold and get your money out and solve that part of your financial problem and go find a rental property or whatever it might be. So that's a huge difference of why, I don't see where the bubble is forming, because it is very solid consumers. Like where I live, 3 people started renovating their house coming out of COVID. And it's a sign to me. It's like, you know what? They're secure, they've got the money, and they're staying put. They have no plans to leave that house. So I think we're going to go through this phase of the longevity of people living in their houses. I think it's growing right now. I know statistically, if you look back, most people say 5 to 7 years. I think we're stretching that out as we speak, where as we go forward in time, and again, if rates go up, that's just going to lengthen the amount of time people stay in their houses. And we had Karen had a new agent in here walking through the halls this morning, and she had mentioned that she's looking at buying an investment property. And I told her, I said, you need to hold that investment property, for the 30 years. It's like, you're going to get such a low rate from where we experience historically. It's like, that is an ideal investment that you just hold on long-term and you write it out. So, anybody who's purchasing a house, as rates go up, they're just going to hold that house longer. So I think we're going to expand that longevity of living in houses out. So it's just, and again, the dynamics are not going to change in my mind this year unless there's some dramatic event that happens, and hopefully not for everybody's sake. But we are in this super low demand, super high demand, super low supply scenario the rest of the year. So you need to adjust your business and realize, you need to work on finding houses that aren't on the market. When one comes on, your buyer needs to understand they need to react right away. It's a matter of, sellers can push the price a little bit and still get absorbed. So it's one of those dynamics that it's here for the year, and I don't see where that's going to change. So anybody have anything to add? Any comments, questions? Karen, how's it going for you? Karen Abrams. I don't know if you can unmute yourself.
Fine. Got my staples out, so my knee feels much more flexible.
Good.
And I had just put into the chat box, well, I think you're just spot on with everything. I do think it's important for people, before they say to people with such confidence, there's nothing, we have no inventory. You need to know what area you're in. In downtown, there is inventory, and it's not moving as quickly as it should.
Yeah.
And even in Mount Pleasant, kind of, if you go out Clements Ferry and you're going to where it's coming into 41, those houses, the peninsula I'm sure is moving, but houses when they're in the 500s and 600s and 700s, they're not jumping off the shelf there, which is interesting. And there's a lot of suddenly new construction out that way. And so they're competing. So I think these are great stats, but I still think you have to know, what neighborhood am I in and what are the neighborhoods around it doing? And go down to that micro level.
To Karen's point, you can sort, I was doing this for all of MLS. You can sort by area, you can sort by price point, you can sort by single family. So to Karen's point, you can break it down for your buyer and or seller of how that individual market is doing. And it'll produce all the same charts that I've shown for the MLS as a whole. Thanks for that, Karen. And I do feel like, when I get your point, Karen, in some areas, but don't you see that downtown market improving though? Even though it's maybe not like the MLS as a whole, don't you feel like it's improving?
I do. I think we still have that fear of flooding in a lot of areas. But yes, I think it's getting better, but I just think we'd have to set a realistic expectation with people that, and certainly the big houses are, there's some big houses, there've been some tremendous sales. But there's still a lot of houses you look at and you think, why isn't this house sold?
So yeah, Karen's making a good point, is you can break it down by MLS area first, and then maybe by price point to see how that price point is doing. And you always want to look at how many active sellers are competing for how many active buyers, essentially. It's like, what's that ratio look like?
I think too, we need to when we're talking to people who may list, particularly if they're in, you know, an area where things are just going like that, that either you need to put in MLS that the seller will need to rent back, or your seller needs to be prepared to move out, like somewhere for 3 months, maybe, you know, which I know is an expense for them, so that they can then jump on the house, because nobody's going to take a contingent offer, I don't think.
Yep. I mean, when you're a buyer's agent and you're writing contingent offers, you're probably not going to win that. If you're putting due diligence in contracts without any sort of justification of like, oh, this is complicated, there's some commercial space attached to it, I need to answer some questions, you know, due diligence contracts are going to lose out to repair procedure contracts. So you also, the terms and conditions are becoming important too. Can you offer, I mean, I had one with 5 offers the first day, and my seller selected one that A, struck the appraisal contingency, and B, offered them a 60-day lease back. So it wasn't just the price. There was a matching, there were 5 offers all over full price. So it was the terms and conditions that won it. And so you have to take all of that in consideration. How much flexibility does your buyer have? And if you're the seller, you know, take advantage if you can of getting those, you know, extra terms and conditions that make a difference. And I pulled this up, Karen, while you were talking. So I just wanted to show everybody, here's Area 51. So inside the crosstown, so you see how you can compare it to the market as a whole. All I did was add an area up here, and I just said MLS Area 51. So you can see over time what's happened. And right now, so we're at, again, this is a 12-month rolling average. So the entire MLS over the past 12 months is 3 months of inventory, whereas the peninsula is 12 months of inventory. So to Karen's point, the MLS as a whole is a seller's market. The peninsula is a buyer's market. So it's funny, within the same MLS, you can have two totally different markets. Now, you could go and break it down even further and do different price points. So just to show you the difference between the markets, but you can see the MLS lowered their inventory by 37%, the peninsula by 14%. So not as dramatic. So the peninsula is improving, just not as fast as the MLS as a whole. So you can see how you can break that down however you want. Now, we do have new construction, and you know, obviously some areas have limited new construction. But those builders to some degree are going to get behind on construction, meaning they're selling houses faster than they can build them. So if you're selling houses faster than you can build them, what are you going to do? You're going to raise the price, right? It's like, oh, how do you slow down sales? You raise the price. So you're seeing, I don't know if everybody's familiar with Liberty Hill, which is right beside Oyster Point in Mount Pleasant. So I wrote a contract with the buyer, and this is a good example. I wrote a contract with the buyer on November 20th. I looked this up. I ratified it on November 20th. The base price of the house was $578,900, right? Base price of the house. If I go online today, you know what the base price of that house is? This is November 20th, right? So a little over 2 months later, it's $654,900.
Oh my God.
It's $76,000 higher. And why is that? Construction costs are higher. The demand was way more than they thought. They have sold too many too quickly. So you know what management's doing is like, whoa, why are you selling all these houses when we can't even build them? Like, we can't build them fast enough. So what are we going to do? We're going to raise prices. And honestly, that might not be quite enough. You know, if they still keep selling them, what are they going to do? They're going to raise it again. So
Usually every 3 sales, isn't it?
Yep.
Basically every 3 sales.
Yep. And so they're $76,000 higher than 75 days ago. So
You
that,
said they go up every 3 sales typically?
so that's what they had told me at the beginning, but I think they took a big step jump here lately because they've sold them so fast. Their management's like, you're going to run out of, we don't have enough land, you know, and this is a problem in some areas. I mean, yeah, you do have some Nexton and Cane Bay that have a lot of land to build houses. Mount Pleasant, the problem is, where's the land? And you can't snap your fingers. There's not going to be a big development coming to Mount Pleasant in 2021. That's not already here, right? You don't snap your fingers and start a 1,000 home neighborhood overnight. So,
But-
so
I'm sorry, even out toward Cane Bay. I was just looking for somebody out at K Hoverian, that's that Four Seasons.
yeah,
And they had, in the week that I was talking to them, they had a $5,000 base price instant up. And I said, why? He said, we can't keep up.
yep.
And so
Well-
and he said, every 2 to 3 contracts, we're going up and up and up.
Yep, and you run that hot sheet. So if you run a hot sheet and you see price changes, do a double check because those price changes are higher, not lower, right? So 2 or 3 years ago when you saw a price change, like, they were overpriced, it's lower. Now look at it, it's higher, it's not lower. So those dynamics are in play this entire year. And I just don't see, I know it's only February 5th, I just don't see where we're going to get to anywhere close to a balance of inventory. So, when you have 15 contracts coming on day one, that means 14 people lost that house, right? So now when the next one comes on, how many people are going to offer on it? The same 14 that missed the last one, right? We have to get to the point where we're not hearing stories like this of 14 offers in a day. So, for the market to kind of start to, reach an equilibrium and balance it out between buyers and sellers. So, I feel a little sorry for buyers today. It's a challenging market, and you have to, and some buyers are gonna have to lose a house or two before they really learn. And I encourage you, if you're showing houses to buyers and one they didn't like goes under contract within hours, even though they didn't like it, tell them, oh, you remember that house we looked at? It's already under contract. So they start to realize, it's like, wow, I didn't even like that one and it sold within hours, or days. So it's a process of educating your buyers right now, depending on what area they're looking at. If things are disappearing quickly, you're out of town buyers, you might have to FaceTime them. They're scheduling a trip here. Yeah, that's probably not going to work in some areas. By the time they get here, it's a totally different inventory because all the ones they looked at are gone. So you have to behave as an agent differently and educate your buyers and sellers on what is happening in the market. So, well, thank you for your input as always, Karen. So, anybody else have anything to add or any questions? So, all right, well, good luck out there this weekend. Hope everybody can find a house to sell. So, all right, well, we'll do this again in the same format a month from now. The first Friday, we do this every first Friday, and happy to have everybody on and input as needed. So, but everybody have a great weekend.
Thanks, Anton.
Thank you.
Thank you.
Thank you.
Thanks, Anton.
Thank you.